Good morning, everyone. It's the 24th of May 2022, brand new day. Let's get started with our daily update. Let's start off with today's headline. The first one that caught my attention is a CNBC article that says the stock market futures show sell-off resuming after market rebound. That is, the sell-off is going to continue after the market rebound that happened yesterday. So I thought, let's go and have a look at the futures. And the article that I referred from CNBC was from 13 hours ago. But even now, the futures are down by 1.5%. So I think the bearish trend is still out there. People are still worried. We'll see the fear and greed index to validate that concept. The other headline that caught my mind was tech market sell-off will lead to broader sell-off like the dot-com bubble. This is the gist of the title of another article on CNBC. And the spirit of the article was that as interest rates keep increasing, it's not that the tech companies have suddenly become bad. The tech companies are absolutely perfect. Their business model is perfect for the demographics and for the times, and they're set up to do very well. However, what has changed is that the expectations of the investors, because of the rising interest rates, is that they want these companies to generate more profit and in a much shorter period of time. And if that's not possible, then they are discounting the price of the company. And that's why we are seeing this route. And that all the route that we have seen in the tech market is going to expand further. And the drop is going to be much more like the dot-com bust. So that's the prediction of some of the experts. And also, one more piece of news that caught my attention is that Snap announced that they probably would not be able to meet the revenue and adjusted pre-tax earnings, which they just projected last month. So something has happened in a short period of time of around 20 to 30 days that has made them realize that what they said would not work out. So that's again a matter of concern. I'd also like to play a video clip for you after this, and I'll meet you on the other side.
Sitting on the sidelines, Tony, and you say until the Fed changes course or there's a policy change, what does that mean? Until they're done tightening, until they say 100 points is on the table? I mean, what does it mean?
Mel, there's a huge difference between what a bottom is versus the bottom. A bottom can come from what we're seeing, a little bit an extreme oversold condition with high pessimism, the perception that the Fed may be discounted in the marketplace, and you still have some okay economic data. That allows you for a rally after that initial whoosh that you get in a Fed-driven, fear-based, precipitous decline. So as you know, Mel, I think it's a lot like 1994, 2000, or even 2018, where you get the Fed comes out much more aggressive than anybody expects, and you just get this powerful thumping in the market, and liquidity kind of disappears, not just in the market, but just in the overall economy. You get a bounce back. That bounce back comes from, again, the oversold condition and the perception that maybe it's gotten too extreme with the Fed expectations. And then you get what I'm going to call the fall, which is the economic reality of what happens when you withdraw so much money.
So what does the bottom look like to you, Tony?
Mel, it's got to be that the Fed says we're almost done, a kind of an Alan Greenspan in 1994, where maybe we've got one more hike in front of us, which was early 95, when the economy almost went into recession.
Oh, wait a minute. That sounds like it's not going to be for a long time, Tony.
Yeah, I know, Mel, people are used to me being so bullish, but it's been a little while. And the reason is, listen to what Neil Kashkari said right after the Fed meeting. Based on mortgage rates going from 3% to 5.25%, we have withdrawn accommodation faster than we gave it in 2020. Think about that statement. Now, my position here on a bottom is, do you sell it down 30? You know, as the team talked about and Karen appropriately talked about, with JP Morgan is down 33%, is that the time to sell it? So I think at this point, you want to really see that tone change in the Fed before you, quote unquote, have to do something. And if you remember, we ended the last show with my dad coming downstairs and saying to my brother and I, don't just sit there, do something. And our mantra this whole year has been, don't just do something, sit there. You don't have to get in on the next downtick thinking it's the low if it's just a low.
Tony, it's Karen. Thanks for being on. So you said until the Fed stops, what would make them stop, do you think? Is it an actual rate? Is it inflation coming in? Is the economy falling apart? What is it?
I think it's inflation expectations, Karen. I mean, it's kind of interesting when you look at the Conference Board CEO confidence survey that came out on the 18th. I don't think on a year-over-year basis it's ever been as bad as it was. It's the worst since a real recession level. If you look at the University of Michigan Consumer Confidence Survey, it's horrific. So I think they're going to incorporate some of that into it. Listen, what Kashkari said I think is really important. When you give trillions of dollars and everybody starts to spend like it's always going to be there, and then you take it away, there's some disruption. And you only know how much in hindsight. So that's when we use our tactical indicators to figure out if near term it's enough. But ultimately, it's got to be inflation expectations. Once they start coming down, which, by the way, has happened to some degree, once they come down in earnest and the Fed believes that they've gone far enough on the inflation data, then you're going to be able to get that real turn.
One of the things you would have noticed in the previous clip is that the speaker was saying that the Fed has taken out as much money as it has already put into the market and a bit more, and that too much quickly, much faster than the way it put the money into the market. So I validated the whole thing, and it seems that the Fed had printed extra money worth around 7 trillion from 2020 onwards to now, and pumped it into the market. And as I can calculate from the losses that the stock market has suffered, I think the stock market suffered a loss of 7 trillion so far. And if you look at the cryptocurrency losses, it's around 500 billion. So together, it's more than adequate liquidity wiped out. And that's one part. Let's park that aside. And apart from that, we also have the Fed, which is going to tighten its balance sheet and at the same time increase the interest rates. And when it comes to tightening the balance sheet, there are two components. One is the purchase of bonds, and the other is purchase of mortgage-backed securities, or MBS. Now, both are happening. Now, ideally, I would have preferred that the Fed had started off with reducing the treasury purchases and thereby tightening the liquidity, and then adding MBS refinancing reduction to the mix to reduce the size of the balance sheet, and somewhere down the line then starting to increase the interest rate gradually. That would have taken things smoothly. But we have to also realize that there is a lot of political compulsion. This is a midterm year, and of course the government in power is going to fare very poorly if you have economic problems, say high inflation persisting at the time of election. So the government wants to have a quick solution, and that forces the Fed to take very drastic action. And I think that's what the Fed is trying to do, tightening very quickly. As we heard in the earlier clip, Fed Reserve has taken out the money much faster than it has put, and it has taken out much more than what it had put into the market from the COVID period to now. So that would indicate to me that capital is going to be very expensive, and it ties in very nicely with the investor expectation that the companies, tech companies, even though they are highly profitable, they have got great business models, and they have got a great outlook, still the investors want them to perform way faster, way quicker, and give higher returns. And if they don't, they are being punished. And it's all because of the steep rate of increase in the interest rate, and also quick mopping up of the liquidity and the losses that have been seen in the market. So that's how I would summarize the whole thing. So to finish this piece, I would like to draw your attention to this chart above, which shows you how the market behaves in a typical election year. And you would see that by the end of May, things should start picking up. However, our model, which I have very well explained to you, is that the second quarter and the third quarter are going to be lackluster and consolidating sideways and moving a level up as and when a risk is resolved, and moving a level down when a new risk is added. So that's going to be the trend for the Q2 and Q3, whereas in Q4 we might probably see the beginning of a upturn, and that could be because in the Q2 and Q3 Fed will start seeing that the inflation and the labor market are all responding to the heavy increases in the interest rates, and also the very drastic tightening of the balance sheet. and that's what is going to culminate in the end of third quarter and lead to some kind of positive growth in the fourth quarter. So that's where we rested today. Let's go and have a look at the Nasdaq and the futures and see what they have in store for us. Let's start off looking at the futures. As I mentioned earlier, the futures are down minus 1.72 for Nasdaq, and that's around 205 basis points. That's a substantial one, and not likely to be wiped out very quickly. It's 8:44 a.m. right now, so you get a context of how soon we are recording this video. So from now onwards until the market open, I don't see 1.71% deficit being wiped out. So definitely we are in bearish territory when it comes to the futures. When we look at the put-call ratio, it continues to demonstrate a bearish bias. It's at 1.01. If it was below 1, I would have said that it's a bit bullish, but that's not the case. So as of yesterday, that's where we left it. And if we were to look at the VIX, the real-time VIX, and look at today's candle, which is this small candle out here, you can see that it's being constrained by the 9-day exponential moving average and supported by the 20-day exponential moving average. So we are most likely to break above the 9-day exponential moving average, as we have already done earlier during the day. The MACD continues to be bearish, and the momentum is above average and picking up. So it's the momentum which is going to drive the day. As momentum picks up, we are going to see the MACD crossing over to the bullish side, and that will be increased. Now, we'll also have to quickly look at the fear and greed index just to see what it says. Let's do that and come back here. As you can see here, the fear and greed index is at 14. It's much better than what it was, say, on Friday. But still we are in the zone of extreme fear, so the volatility is going to be quite high, and that's what we should be concerned about. So the market will be very choppy. We have to be very careful. Now coming back to our indices here, the overall prediction I make is that volatility is going to be higher today as we get further into the market. Higher volatility means the price is going to be all over the place, and people are likely to have losses. The markets are likely to go down ultimately. So that's what it looks like right now. Let us look at other indicators. I'm going to look at US oil, and US oil is continuing to push against the 110.48 resistance that we have out there, and it has got support from all the 4 exponential moving averages. MACD is still bullish, momentum is still above average, so anything could happen in this space, and we have support for oil at 107.52, as you can see in this horizontal green line. So that is this narrow band within which we have been moving for the last 4 days. We exceeded it a bit maybe 4 days ago, but that's where we have been. So the markets are trying to find a place where they can go. There is, on one hand, there is this fear that all the demand destruction is happening too fast from the Fed as well as from the global economy, with the geopolitical forces being in there. Therefore, businesses are likely to perform badly, and people are likely to lose their jobs. So in those circumstances, it is felt that oil demand is going to fall, and that's the doubt that you are seeing in this chart out here. People who are speculating in oil are wondering whether the high price of oil can be sustained if demand falls down, if production falls down, if people lose their jobs and consumption goes down. So that's one of the factors. The other factor that's happening is that during the weekend, while Biden was in Japan, the OPEC has, Saudi Arabia, I think, had announced that they're going to have a talk with OPEC Plus for increasing the production. Now, OPEC Plus includes Russia. So we don't know what's going to be the outcome out there, but at least some noises are being made to increase the supply of oil, which means there will be downward pressure on the price of oil, given everything else being constant. So all those things are being resolved right now in this chart out here. We'll have to see where it goes. And all of us retail traders, we just have our mini budget and our mini portfolio and our day-to-day expenses. And there are professional fund managers who are working with billions of dollars of asset across the globe. They work in a different scale. They have different expertise. They're going to figure out this puzzle, and they're going to move in a particular direction. And if that doesn't turn out to be right, then we're going to move in the different direction. Practically, that's how things happen. Nobody knows for certain what the future holds. People take their best guess. Once they have a force of conviction, they put their money into it, and then the market tells what's going to happen, because the chips fall where they may. and people change their course after that. So that's what is going to happen. That's why we are seeing volatility. When everything is predictable, that happens when VIX is around 20 or below. It's very predictable and you can do a lot of swing trades. We are not there in that position yet. We are in volatility. So be careful when you're out there. Now let us look at our 10-year and see what it predicts. If you look at the 10-year, we are still in the same range as we were yesterday. Albeit we have come down and we still have 9-day and 20-day exponential moving averages constraining us. MACD is bearish and momentum is below average. So it's all looking good in the 10-year time frame. In the long term, I think people are getting settled down. In the short term, in 2 years, we are still in the range like yesterday, but we have fallen a little more. So 2 years also, 2 years out also, people are feeling slightly more comfortable. So that's a good one. And we are looking at the US dollar index. And if you look at the US dollar index, we are still within yesterday's range and we have slightly gone up. It's a doji candle, so there is a question in the mind of the investors whether there are better places to put the dollar. We don't have the answer yet. Probably we'll get that in market open. If US dollar index goes up, you can definitely expect that money is going to come out of gold, crypto, and stock market and other places. So it's negative for everyone else. But if the dollar index continues to go down, you can imagine that the money is going to go either into gold or stock market or crypto or all of them in proportions. So that's what I would read from here. Right now, markets are indecisive. As you can see, it's a doji candle. It could go each way. Both the wicks are equally balanced and there's a thick middle body out here. MACD is bearish. Momentum is below average. If momentum was above average, I would have been confident making a prediction, but it is still below average. So we'll see where it goes when the market opens. And that's the definition of volatility. No one knows what's happening. Everyone is watching everybody else and reacting, and somebody else reacts to their reaction. And there's a cascading effect. All this turmoil will settle once the VIX goes below 20. Now, having said that, let us look at our QQQ. QQQ shows that early morning pre-market trade minus 1.58% down, that is $4.61. So it's not looking good, but we have the support here at, I'll say this is at 288.41, and that's going to hold on for us. And we have a resistance here at 292.96, which is being tested right now. MACD is almost ready to turn bullish. Momentum is below average and picking up. Let us see what the future holds for us. Even if we break through 292.96, our next resistance is the 9-day exponential moving average, which is the yellow line you can see out there, which is at 296.16. So that's what the market looks like today. And if you go to S&P 500 and look at it, you will see that we are being constrained by the 9-day exponential moving average. Again, here, MACD is on the verge of turning bullish. Momentum is below average, as pointed out, and it's pointing upwards. And there's a very good chance that we're going to break through the 9-day exponential moving average. And then we'll have a resistance, minor resistance, which is out here at 405. And we also have the 20-day exponential moving average converging with it. So that's likely to push us back down. But overall, other trends are showing bearish. And if you look at the pre-market here, it's down minus 0.93. S&P always does much better than Nasdaq. So S&P will be doing a little bit of positive before it turns negative. Nasdaq is going to be the leading indicator for the negativeness, in my opinion. With that said, let's go and have a look at the genomic shares. Oh, I forgot to mention one more thing. If you look at this daily time frame, you can see that we have had a double bottom out here. So there's a good chance that we are going to go up and break through this. But if we did not, and if we came down, then we might probably be forming a head and shoulder pattern, which again, inverted head and shoulder will be a bullish pattern. Let us see what the market unfolds for us. And now we are looking at the genomics sector. I'm going to just quickly sort this out so that we have the winners on the top. Yesterday was a mixed bag. We had a bunch of winners and a bunch of losers. Among the bunch of winners, one of my predictions that went wrong was that I thought that CRISPR would be among the winners. But unfortunately, CRISPR lost the most yesterday. So that was a wrong call on my part. But if you look at the ones that have succeeded yesterday, Verve is on the very top with 3.88% gain. And it has converted the 9-day exponential moving average into a support. And the MACD is bullish and the momentum is still picking up. So there is more juice in Verve today in order to challenge the 20-day exponential moving average at 14.60. Pre-market, there are no trades, so we don't know which direction it is going. Same case for Vertex, there is no pre-market trades, but it has converted a resistance at 261.24 into a support. So I marked that as a support. Our next resistance is going to be this diagonal green line that you see here, which was a support for a long time and which has got 3 touch points. So it's pretty strong. So we'll have to see what happens out there. And by the looks of the chart, it seems that we're going to test that today because both MACD is bullish and also momentum is above average and pointing upwards. So that looks good. I'm just going to go quickly to the 1-day time frame to see where the momentum is. But here the momentum betrays us because it has gone below average and it's pointed downwards on a daily chart. So when I look at this situation, I'm a bit sanguine about where we are going to be with regard to Vertex. We'll see what happens when the market opens, but Vertex is a much healthy stock. I would like to see it go up before it comes down. Regeneron is up 3.14%, and again MACD is bullish and momentum is pointed upwards and above average, and it's looking good on the charts as well because all the 4 exponential moving averages are supporting it. And since we have gone above the resistance at 646.94, I'm going to mark it as a support, and that's going to be the ultimate support for today if the market decides to turn around. And our next resistance is most likely to be, I'm going to plot the next resistance out here to be somewhere around here at 688.68. So this is going to be the resistance for us. We are going to test the resistance today, and I think that we are going to be able to break through that for Regeneron, but ultimately there's a good chance that we might come down because too much of tightening is happening too quickly, as we saw before. DNA is up 2.68%, again constrained by the 20-day exponential moving average. MACD bullish, but momentum is below average, so not sustainable. PSCB is up 2.32%, and as you can see, I'm expanding this. As you can see, yesterday we had drawn 2 parallel lines, one of resistance and one of support, and we have still continued to stay within that. So PSCB is consolidating. It's been consolidating for the last 1, 2, 3, 4, 5, 6, 7 days within this range. So I would expect that PSCB is building up for a breakout, and MACD is bullish and momentum is below average. So we need the momentum to go to above average for the breakout to happen. So maybe we might see more consolidation today, moving between these 2 ranges. I'm going to put this upper limit as red just to show that it's a resistance out there. IMTX, it's tried to break above this line of resistance up here, and it has managed successfully on both yesterday and day before yesterday trading days, but it has not been able to open above the line of support. And today we don't have any pre-market trades, so we don't know if we are going to replicate something similar today. If you look at the MACD, it is bullish and momentum is almost reaching average. So because the momentum has been tending towards average but not crossed above average, I think that the markets had opened lower. So today there's a good chance that we might open at or just above this horizontal green line of support, which stands at 7.20. There are no pre-market trades so far for us to get any cues from. When you look at Novartis, it's up 1.44% as of yesterday. Yesterday's close, and it has gone above the support at 90. This support, which is at 90.63, and we have got a lot of resistance which have been converted into support. We have not been updating this chart very often. That's my bad. I'm just going to quickly mark these supports so that we are absolutely contemporaneous when it comes to our charts. I need to do this bit of housekeeping. Sorry about that. With that done, so we are all in a good shape here with all the exponential moving averages supporting Novartis. Novartis is likely to test the resistance, which is happening to be at 91.29. Pre-market, we are already at 90.88. There's a gain of around 17 cents. So this is positive. And now let us look at Pfizer. Pfizer is up 0.78%. It has converted the last resistance that we had plotted into a support, and our next resistance is this diagonal line, which was a support for the longest time, and it's going to be a resistance that we are going to test. And today we are going to test it at around 54.39. That's our max level for today. MACD is absolutely bullish. Momentum is above average and pushing up. Pfizer should not have trouble reaching this resistance. What happens after it touches the resistance is a different story. So let's check that out as the day progresses. Let's go on to Teladoc, which is up 0.76%. It is still within that consolidation range. It's moving absolutely in the center. It's consolidating very, very tightly, ready for a move. I don't know whether the move is going to be upwards or downwards because we have this gap up out here. I think it has to be upwards so that we can fill up this gap. MACD is bullish. Momentum is below average. It has to go above average for things to start looking good. IDNA is for the genomic industry as a whole, and it's still range bound within the two ranges that we plotted. This is the resistance level that we have here, and pre-market we have no trades as yet, so we'll have to wait and see what happens out here. If you look at the MACD, it is bullish, but the momentum is below average. It has to go above average to be consistent. We have the support from the 9-day exponential moving average, so that's a positive, but the resistance is very strong. The horizontal minor resistance coupled with the 20-day exponential moving average sitting at 29.48, which is this orange line, is going to give stiff resistance for genomics. So genomics is going to have a mixed day again today. Some may have raise in the morning, and many will have a fall in the evening to end up red. And that's my prediction for genomics on the whole. So with that said, I'd like to bring the session to a close. I've tried to change the format. I'm working on this. It will get smoother and better. So I thought we should do something better than just a PowerPoint slide on the background. So please bear with me while I get this new format in place. And if you did like the video, please put a thumbs up. If you like the PowerPoint format, please put it in the comment below so that I revert back to that. And if you're not yet a subscriber, please subscribe and join our community for everything related to CRISPR and the stock market. Thanks and have a great day. I'll talk to you again tomorrow. Bye for now.